Good morning. Welcome to the Monday Market Update. My name is Nash Paradise, Director of Sales at UMortgage. Let's jump right in and take a look at where rates are, why they're where they are, where they're going, and what to do with it. So getting into last week and our volatility meter here, we're going to forecast this as pretty flat, but flat's hard to use here. We ended pretty flat without a lot of change. It doesn't mean there wasn't a lot of econ data. It doesn't mean there weren't a lot of misses, a lot of really interesting data points that markets just didn't seem to care about. There was no good movement. We had, some huge misses last week, some pretty big beats, and no one cared. So where to go from here? It's hard to say. The markets are being a little funny right now, kind of picking and choosing what's going to matter. And then things are starting to snowball. With all the news that we got, over the weekend, there's a lot of conspiracy theory going around on different financial markets, cryptocurrencies taking some hits right now. There've been sell-offs in, the S&P 500, gold, silver. There's just stuff moving all over the place. So how does this impact interest rates? Well, we were pretty flat. 10-year Treasury didn't move a whole lot. Mortgage-backed securities didn't move a whole lot. Finished the week at 6.16 after starting at 6.19. Let's take a look at what the econ data was last week, where these hits and misses were. Checking my sheet here, and of course, we got the Federal Reserve interest rate decision on Wednesday. It's staying fixed at 3.75. This may be the first time that we've had a Powell press conference that didn't move the needle. It was completely and nothing burger with cheese. There was nothing real interesting going on. Definitely data dependent. They did change sentiment a little bit, that they're not so worried about jobs right now, not so worried about inflation. Everything is kind of okay. They've seen some pickup in the labor market. So, smooth and steady going forward, possibly. But that was, the big mover midweek. But at the end of the week, this is where we got these huge misses. Look at these PPI prices. The month over month PPI came in 0.5% high. And then on the core came in 0.7% high. I mean, these are huge misses. Overall, the PPI year over year from 2.9% on the projection to 3.3%. That's massive. I know there's rounding that's being taken into consideration there, but still, those are really big misses. And what did we get Friday? Nothing. Rate stayed pretty much the same. There was not a lot of movement going on. But why? I can't tell you. These things should matter, but right now markets are not being moved by inflation. I guess inflation is what it is, and they're writing this off as a one-off. We'll see as we get into all the employment data this week, whether or not that's going to move things. Funny enough, the biggest movement that we've gotten in, a couple weeks now is from this morning. So let's check out this week's economic calendar. And on here, you see nothing really crazy looking on Monday. You got ISM PMI, and as I've got the live chart in front of me, it's a big miss. Forecast was 48.5, came in at 52.6. 50 is square even, right on the money. So manufacturing is up, and where manufacturing goes, where that money goes, usually inflation and labor follow. So it is fairly interesting to see how that is actually moving things. Other big stuff coming this week. We got jobs information coming on Wednesday with ADP, ISM PMI on Wednesday, And then Friday is a big day. Friday is non-farm payrolls, average hourly earnings, Michigan consumer sentiment, unemployment rate is coming in. So the only thing that I'm seeing that looks kind of interesting on here for the forecasts, looking at, a 4.4% unemployment rate for January. Previous was 4.4%. Non-farm payrolls are projected to come in at 70,000. There is some room to miss there. So Friday could be a volatile day, but after last Friday with having huge misses all over this place and no real movement, it's hard to say where things are going. So let's talk about the Fed. We just got this cut. When are we going to see the next one? And is this relevant? So looking at our projection chart here, we saw that. We know we're going to be in this 350 to 375 range here for a bit. We're not going to see a cut in March. We're unlikely to see a cut in April right now. Based on Powell's statements on the presser, everything's going to just kind of hold, kind of chill. We're anticipating one more cut and then a lot of chilling for a little bit. We've got this cut projected in June. I say chilling, one cut, two cut. We've got the two for this year. And right now, June looks like, it's 80% certainty here. The interesting thing about the June projection, while it is still projected to be the first cut, there's 20% on the level of not cutting. There's not anything on the level of like a double cut or getting a little more advanced that would tell us that there is a high likelihood of April being back into consideration. There have been a couple times where April was looking like kind of 50-50. And now it's just moving further and further away from that as we get more streamlined data, and everything seems to support this, just hang out and see mentality. Do I think we're going to have that 6 cut, chill 7, and then move in September again? That's where it's hard to say. I do think we're going to pause, making another rate cut when you only have 2 scheduled for the year after only a 1 meeting break. I think it's unlikely. The Fed doesn't love moving really fast unless they are doing it too late in the cycle. So I think having some projections, knowing where things are going, not anticipating anything major crazy to shake up markets, means we're probably looking at that second cut. I'm thinking October right now, but we'll continue to see how this goes and where it's going from here. So what does this look like on an interest rate side? Getting into the chart on where mortgage rates have been, like we talked about last week, we had this really nice little dip for a very short amount of time. This is your tweet dip. This is not a real dip. This is the anticipation of what may come and how the market is going to react from it. So Fannie Mae is going to buy $200 billion in bonds, or the Fed is going to start investing the quantitative easing. We're going to see a $40 billion purchase, sometime next week. Cool. It moves on news, and then that news resets, and now there's new things in the news cycle. So we got that pop and it hit it back up. Since then, it's kind of just stayed consistent. Looking all the way back to September when we started getting a little bit higher volatility, these 3 rate cuts that we've had so far, this non-cut, there's no reason to believe that, by the end of this week, into the next couple of weeks, that we're not still somewhere in this 6 to 6.25% range, hovering around 6.15 looks to be fairly consistent going forward. That doesn't mean we can't have some, negative movement, especially week over week, day over day. We've already moved a good bit so far today, 20 basis points on the mortgage-backed security pricing. So not an ideal start to the week. Could reverse midweek with the jobs information that comes out. Hard to say for sure. But as always, if you like it, lock it. If you're going to be, circling a day on the calendar to be careful and not have something floating, Wednesday's the day with some activity, but Friday is a big day. As we get into the end of the week, investors tend to hold those gains a little bit, leave some meat on the bone, so to say. And I would not be taking anything into Friday hoping that the jobs report improves pricing. It very well could. There's just a high enough risk that it goes the opposite direction. And then you're caught holding the bag over the weekend, which is not a great spot to be. So in summary, nothing's working the way it should. I have no idea what's going on, and why even tune it now? Markets aren't reacting the way that they have previously, even months ago. Maybe we get back into regular market movement this week. If not, we'll just dive in deeper and see what is causing treasuries to trade the way that they are. What is going to get treasuries excited? It wasn't PPI, which they typically love. So will it be employment? Will it be jobs reports? They like manufacturing so far this morning. And by like, I mean are moving on it, even though it's not in the way that we want to. we'll just see how things go. So be sure to check in next week. We'll break down what happened all this week, what's coming in the future here, and how to best equip your partners, your borrowers, your clients, and yourself to know what do we need to do, how do we need to handle this going forward, and how can we best serve the community. Thank you.